The Juneteenth shortened trading week ended mixed, but mostly flat overall. The week saw slight gains in the Nasdaq and the Dow, and losses in the S&P 500 and the global indices as concerns about Israel and Iran began to really set in. The slight loss for the S&P 500 was the narrowest weekly change since this time last year. While the weekly close was mostly uneventful, the week was loaded with headlines. The largest economic event for the week was the FOMC meeting midweek. But, as expected, the Fed kept interest rates unchanged at the 425 to 450 basis point level. In his statements, Fed Chairman Jerome Powell opened effectively stating that the Fed has been hesitant to make changes to interest rates due to the uncertainty and concerns around the potential impact of tariffs on GDP by saying,
"Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March.
Despite the concerns, Powell continued to highlight the overall resilience of the labor market and how stress around various economic indicators have subsided since April. The Fed's inaction was met with the displeased President Trump, who wrote that rates should be 2.5% lower than it is today. Meanwhile, some Federal Reserve members have started to come out in favor of lowering interest rates. On Friday, Federal Reserve Governor Christopher Waller said in an interview that he doesn't hold as pessimistic of a view on the impact of tariffs, and that,
"Steve, as I've been saying for probably a year, I think the important thing for central banks to do is to look through tariff effects on inflation. This is a long-standing view going back 40, 50 years. So any tariff inflation we should see, and I've given various estimates that I don't think it's going to be that big, and we should just look through it in terms of setting policy and look at the kind of underlying trend of inflation, and that we could do this and as early as July."
Other economic news came in softer as the Empire Manufacturing Survey missed expectations. This was followed by weakness in retail sales, industrial production, homebuilder confidence, building permits, and housing starts. Finally, in geopolitical news, tensions with Iran escalated leading into the weekend. Even before the Saturday military strikes on 3 nuclear sites in Iran, oil prices climbed 3.6% higher. That said, crude oil prices are still lower than this time last year, and significantly lower than the peak back in April of 2022.